If you've been following our channel, you know that we're constantly talking about the importance of you being in control of your money or regaining control of your money. So why is it so difficult? It's a very simple concept.
Today we're going to talk about the unintended consequences that result from following traditional, conventional wisdom when it comes to your finances, and how to regain control of your money by just knowing these things. So stick around to the end of this video. I'm Olivia Kirk.
And I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, please be sure to subscribe to our channel and don't forget to hit the bell to be notified when we upload new videos every week. Now, there are three main institutions that are trying to gain control of our cash flow on a monthly basis: the banks, Wall Street, and the government. And it's a game to them in the sense that there are rules. Rule number one is they want to get control of as much of our money as possible. Rule number two is they want to get that money on a systematic basis, meaning they want their hands in our checkbook every single month. And rule number three is they want to hold on to control of that money for as long as possible.
We're going to take a look at how Wall Street gets us to act in their best interest by following the rules that benefit Wall Street. Rule number one, they want to get control of our money. So how do they do that? Well, they tell you that the only chance you have to beat inflation is to be in equities. They tell you that you have to be in it to win it. They tell you that to employ strategies like dollar cost averaging. That's how they get us to do things on a systematic basis. And then they also tell you that, the higher the risk, the higher the reward. So these are things that they tell us to get us to play the game by their rules so that they could win. Another thing they do is when the market's down, they tell you, well, you can't sell now because you're going to be locking in losses. But when the market's up and you say, hey, I want to sell because I think we made a pretty good profit, they say, well, geez, I don't want you to miss out on this profit. Plus, if you sell now, you're going to have to pay taxes on the gains. So if you don't sell low because they don't want you to lock in losses, and you don't sell high because they don't want you to pay taxes or miss out on a run, when do you sell? Well, for Wall Street's benefit, they never want you to sell. You see, their job is to get you in the market and to keep you in the market at all costs. That benefits them, but it doesn't necessarily benefit you.
So how do the banks get us to do what's in their best interest? Well, let's take a look at the rules again. Rule number one is they want to get our money. And when it comes to a mortgage, we want to put down as high of a down payment as possible, because with a lower loan, a lower mortgage will pay less interest. Rule number two, they want to get our money on a systematic basis. So they'll entice us with lower interest rates on shorter term mortgages. For example, a 15-year mortgage will have a lower interest rate than a 30-year mortgage. And rule number three is they want to keep our money for as long as possible. So with the 15-year mortgage, we're giving up more of our monthly cash flow to the bank, even though we're paying them less interest. We're still losing control of that monthly cash flow. And with the home equity, they tell us that it's our home equity, as if we have control of it. And we're more secure when our house is paid off. But in reality, we don't have access to that money unless they give us permission to access that home equity. So who's really benefiting from a shorter mortgage, us or the banks? And the answer is clear. The banks are following the three rules and they are in control of our money by positioning it as if we are in control and it's in our best interest.
Finally, the government gets us to play the game so that the government wins by enticing us to invest in retirement plans for our future. And they give us a tax deduction on a small amount of money today so that money can grow on a deferred basis, and then they have the potential to tax us at a much higher rate in the future.
So think about it. You're putting money away today for a small tax deduction, but in the future, the government determines how much of that money you get to keep. So even if you earn a decent rate of return over however many years, you don't know how much of that money is actually going to be available to you to fund your retirement lifestyle.
So the government gets us to play the game, but the government is also consulting with Wall Street and the banks to create the rules. And who also benefits when we participate in retirement plans? Well, Wall Street benefits because they get to hang on to our money until 59 and a half, or what happens? We pay a penalty and tax. Secondly, the banks benefit because if we're maxing out our retirement account contributions, that means our money's tied up, and then when it comes time to pay for our children's college education or buy a car or go on vacation, what happens? We don't have access to money because our money's tied up in retirement accounts or home equity, and therefore we have to borrow more money. And who benefits when we borrow more money? Obviously, it's the banks. Well, we've looked at how the government, Wall Street, and the banks get us to follow rules so that they can win and can be in control of our money. So what's the alternative to following their conventional financial advice?
Well, the alternative is to save in a place where you have full liquidity, use, and control of your money, where your money could grow on a continuous compound interest scale and never be interrupted even after you spend the money. And we accomplish this by saving in a specially designed whole life insurance policy where we get to control our money, where we have full liquidity, use, and control, and access to our cash value for whatever we want, whenever we want. So we're not forced to go to the banks to borrow and give up control of our monthly cash flow. If you're interested in learning more on exactly how we accomplish this, please check out our free web course at tier1capital.com. And if you like this video, please be sure to give it a thumbs up and don't forget to subscribe.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters.